Good evening, everybody. Thank you for joining us for our webinar session and I should say our Zoom session this evening. My name is Nicole. I am the Community Outreach Manager with Mid-Minnesota Federal Credit Union. And today we have Veronica and Ginger from our Mortgage Service Department that are going to talk to you about choosing the right loan. So Veronica, Ginger, go ahead and take it away.
As Nicole said, I'm Ginger House, and I have been a mortgage lender here with the credit union for about 15 years, and I've been in the industry about 20+ years.
And I am Veronica Franzen. I am a mortgage loan officer with Mid-Minnesota. Been in the lending industry for 20+ years.
So tonight, we're all here for choosing the right home loan. And I'm going to start out with talking about why understanding loans matters. On a mortgage loan, it's going to be a long-term commitment, right? And probably the biggest commitment that you're going to ever make, that biggest loan payment you're ever going to be make. And an exciting time and a scary time, usually all tied up into one. And so we're going to talk about some of the differences in that and making sure you understand. And choosing the right loan for you and your situation is going to make sure that it's saving you money, that it aligns with what your financial goals are. Also then, as a reminder, not all loans fit everyone. You may have a friend that had gotten a loan and maybe they were doing 0 down, maybe they had a down payment, and not all loans fit everyone. It's not a kind of a cookie cutter thing. It all is going to go off of what your situation is, what your income, your assets, your credit, your situation, and then you can kind of find what works best for you and get you into a home.
So understanding different mortgage types. So we have basically 4 different types of mortgage loan options that are out there. So fixed rate mortgages, and we're going to get into these. We're going to dig a little deeper into each one individually. So there's fixed rate mortgages, adjustable rate mortgages, which are also known as ARM loans. And then the government-backed loans such as FHA, VA, USDA, and then conventional loan programs as well.
I'm going to talk about first our fixed versus an adjustable rate mortgage. Our fixed rate mortgages, those are going to be predictable payments. So the payment is going to stay the same. It's not going to increase. It's going to stay that over the life of the loan. The interest rate is typically fixed, so you don't have to worry about that adjusting as long as you have that loan as well. And it's also ideal for long-term stability. You're just going to kind of know what your payment's going to be for that full time that you have it, so that it can help you plan financially and budget what you have going on in your household. And then we're talking about ARMs. That's going to be lower initial rates initially, usually, and then over time it can be a yearly or every couple of years that payment can adjust up or down according to whatever the interest rates are doing. ARMs usually require 20% down, and they can usually be fixed for 5 years, 7 years, 10 years before they can start adjusting, which would make that payment go up or down. Also, it allows you maybe to get approved for a higher amount to purchase a home, because that interest rate initially is going to be at that lower payment for that initial time frame that you choose, maybe like we said, that 5, 7, 10-year period. And those are typically averaged over amortized over 30 years.
Great. So some of the different loan programs. So what are government-backed loans? The government-backed loans are the FHA, VA, USDA. So for FHA loans, they require a low down payment, which can be as low as 3.5%. And then some flexible credit requirements. So for our FHA program, for example, the investor that we use, generally they need a minimum of a 620 credit score on that one. VA loans are exclusive to veterans with no down payments required. And again, with our investor that we use, it's got a minimum credit score of a 600. And then for the USDA loans, which are also known as rural development, for rural areas, no down payments, minimum credit scores on that one for our investor are also 620. With that one, it does have at times some income limitations based on the county that you're purchasing in. So with the government-backed loans, sometimes with those, the rates are sometimes better than like a conventional loan, for example. They're more designed to help borrowers who may potentially not qualify for a conventional loan. And then, well, with any loan, the closer you are to that minimum credit score requirement, you may have to show some additional assets or reserves. So higher credit scores, the better, sometimes help out, but that's it on that one.
So those are the government-backed loans. I'm gonna talk about the conventional loans. Those are typically you're looking at anywhere from 3 to 5% down on the minimum payments. The 3% down is going to be if you have never owned a home before, or at least one of you has never owned a home before that's on the loan. Minimum credit score, you're looking at minimum of that 620. You are going to have private monthly mortgage insurance if you put down less than 20%. That's also going to be based off of credit scores, and the closer you are to putting 20% down, the lower that amount's going to be. To avoid private monthly mortgage insurance, you need to have down at least 20% of your purchase price. And that's also going to require you to have, as I was just talking about for that down payment, depending on your credit scores as well, that's going to affect maybe your down payment options. It is also going to offer a little more flexibility as far as loan terms. You can do a 30-year, 20, 15, or 10-year amortization. And all of those interest rates are going to be a little different as well, depending on the term that you choose. As Veronica was saying, with the government loans, sometimes depending on what your credit score is, you may need to have additional assets that we need to get verified to get you approved for that loan.
All right, so how to choose the right loan. So as the lender, I would help you to kind of go over the pros and cons of each one, which scenario might fit best for you. A couple things to keep in mind. Your financial health, for example, so where your credit score's at, your debt to income ratio, so the income you have coming in versus the debt that you have out there. The debts are anything that's basically on your credit report. So usually like a cell phone, garbage, those sort of things don't count. So you also want to look at loan terms and interest rates. So each program, so the government's versus conventional, for example, you want to look at different loan term options, what fits your scenario best. Same for the down payment options. So the government-backed ones have a couple of $0 down payment options, where conventional is going to be 3% for the lowest, or 5% if you're not a first-time home buyer. And then also thinking about your future plans. So are you planning on moving anytime soon? Are you staying long-term? Growing family? Those sort of things. So all things to consider.
When you're looking at getting ready to get pre-approved, First thing we're gonna look at, or you're gonna wanna make sure, right, is what does your credit score look like? And maybe how do you improve your credit score? Those are things that we're gonna go through with you and maybe advise you on what you could look at doing to increase your credit scores. And maybe you're not quite ready right now to purchase a home, but what do you need to do to be ready in the future? We're also going to look at your income documentation. We're gonna have pay stubs, your W-2s, taxes, maybe you're self-employed. Maybe you are on social security, you receive pension, stuff like that. We're gonna look at all of your income information, review that. And then we're also going to, then that's really how we're gonna get you pre-approved. And you probably hear sometimes people talk about being pre-approved or pre-qualified. Pre-qualified, they're really, it's a soft pull to your credit, and it's really just based on, you know, sometimes conversations you have or in that application, just what you've entered in the application, not necessarily doing a full verification of review of income, assets, credit, things like that. Where a pre-approval, we're gonna do a hard pull to your credit, so it can affect your credit scores. That is good for 4 months or 120 days. And then we are doing a full review of income, assets, credit. So that's really what the difference is. A pre-approval usually is gonna be, I would say, kind of more, I don't wanna say either one are acceptable, but pre-approval, a little more solid pre-approval when you're making an offer, because we know all of those items have been reviewed and you're good to go to write an offer on home.
All right, some common mistakes to try to avoid, over borrowing beyond your budget. So there are some lenders, for example, that may approve you for more than you're comfortable with, you know, an affordable monthly payment. So I usually try to find out what a comfortable payment is for you per month, and then try to work the pre-approval that way. Instead of just going, here you are, you're pre-approved for $500,000, happy house hunting, and you don't know necessarily what the payment is and all of that. So you just want to keep all of that in mind. Ignoring loan fees. So there are closing costs, which are considered your loan fees. Some, you know, are very focused on rate and don't pay attention to the cost to get that rate. So just keep that in mind as well. And misunderstanding loan terms. So for example, on an ARM loan, not fully understanding how those work, that the rate is only fixed for a certain period of time, that after that, you know, 5, 7, 10 years, that your rate can adjust and that can affect your payment. And may not be something that you're gonna love, depending on what it does. So that's it.
I think that's kind of everything that we had in a quick run through. Nicole?
That one was quick.
Yeah.
I'm not seeing any questions coming through as of yet. So anybody that is on the virtual side of things, if you wanted to send any questions that you have through the chat function, feel free to do that now.
I've got a question.
Yeah.
Construction loans.
Yep.
And how do you take, buy a lot? Then how do you obtain a construction? Or not? My son could probably build me a house. He is licensed for. Full house. How do you go about that?
So some of this process, right, the basic process is gonna be the same, but you would come in and want to get pre-approved, so you can know really, and you afford what it's gonna cost him to build you your home. You're gonna wanna have an idea of what is it gonna cost for him to build the home that you want. And in this case, if you would be buying land at the same time, you know, we could kind of have a general idea of, you know, what's the going rate for land, maybe where you're looking, right? To kind of use those as a starting point to see if we can get you approved for that amount that you need to have. If you're doing a construction loan with us, if you're using a builder, you're gonna need 10% down. So 10% is calculated based on whatever the purchase price is of your land, plus the cost of your build. You need 10% of that number, plus whatever your closing costs are. If you already, say if you were already owning the land, but say, okay, I'm not really quite ready yet, you know, maybe I don't have that money down that I would need. Some people, will look at buying land first. Maybe work on paying that loan down, paying it off, and it depends on the situation. Land is 20% down, the purchase price plus your closing costs, that's gonna give you a lower payment usually. And then they come back, maybe that spring, maybe in a couple months, maybe in a couple years. But then look at building again, and now we're gonna be able to use equity that a person has in that land to go towards their build, so maybe they don't need that money for down payment.
Yeah, my daughter has property that they're trying to sell, and they want to just buy renovate the house, but. And they're in the lot that they want is 2.5 acres. But, you know. So, but, you know, but he's licensed, but you have to have a. Well, he did his own, I don't know, I should ask him, he did his own loan.
So you can build it yourself, or in this case, right, use your son, if he's not a builder, then you're gonna have to have more money down. And it'd be 20% down. Instead of 10% of your purchase price plus the cost to build, then it'd be 20%.
Yeah, so it depends on if it's a contractor or a self-build, is
Yep.
basically
Yeah.
the difference.
Yeah, they definitely had.
Sometimes the land,
Sure.
like
Yeah,
if they
he owns
own the
land
land
too.
already, then that can be helpful to help with potential down payment or closing costs.
So a lot of
There's some
people
equity in it,
sometimes will go the land route first.
yeah, buy it and then.
Well, now they're trying to sell it. Like. I can't talk. I want her out of her trip.
Good question.
Yeah. And that is the other thing, I mean, we didn't talk about, these are geared more towards home loan or purchasing and such, but
Yeah.
other options. Purchasing land, that's something that we could do as well, and construction loans.
Mhm.
Which we were kind of talking about here, a little bit in person, so. Other options as well.
Veronica and Ginger, we had two questions that actually came through, two great questions. First one, can you go over what documentation would be needed for upfront to get pre-approved? And the second question, is there a particular loan type that is best for first-time home buyers?
So I'll hit on the documentation. So basically what we're going to need, depending on your situation. So if you are a W-2 employee, not self-employed, so we're gonna need last couple pay stubs, W-2s for the last 2 years. Generally in the mortgage world, 2 years is the magic number of where we need to see things, so 2-year employment history, 2 years of housing, you know, we have to see where you've been living and such. So pay stubs, W-2s, income, assets. So bank statements, any retirement accounts, those sort of things may be helpful. Depending on if you're owning a home or not. And for first-time home buyer, can I do that one? Programs. For first-time home buyer, pretty much all the programs can work for first-time home buyer. So you got to keep in mind that there isn't a program that is called first-time home buyer, so it's conventional FHA, VA, so on and so forth. So those programs themselves will work for first-time home buying. So the $0 down payment program through rural development, USDA. VA will work for first-time home buyers too, conventional. FHA, they just have different requirements with them. Sometimes with first-time home buyers, you have to keep in mind that there still could be down payment and closing costs, which are two separate pieces to that.
Down payment.
Yep, and then sometimes there's down payment assistance programs that are out there too that we can look into which could potentially help with down payment and closing costs, if there are funds available, and it's not always guaranteed, but something that can be looked into, definitely.
And some of those down payment assistance programs, they have income guidelines and requirements of what you can make. So we have to make sure that you qualify to receive that. It's a good question.
And if those programs accept that program. So, but that's what we get to do, is find out what.
I don't see any of the other questions coming through on the virtual side. Some of the questions that we have gotten before, and maybe you guys want to just touch on this a little bit. Did you talk a little bit about minimum credit scores at all?
Yep, each program.
Each program, we kind of talked about it.
Which we can do a quick rundown again too. So conventional is generally a 620 minimum credit score. So one thing to keep in mind with credit scores too, so all 3 credit reports are pulled. So Equifax, TransUnion, and Experian are all pulled in. And if, for example, there's 2 borrowers on that loan, it's gonna look at the middle credit score for each borrower. And whoever has the lowest middle credit score is what it goes off of for that. So again, conventional minimum is 620. Pretty much all of them except for VA are gonna be 620. VA is allowed on our program, or excuse me, our investor that we use, as low as the 600. But everything else, the FHA, USDA are gonna be 620.
Thank you.
Betcha.
So to get started, if anybody would be interested in getting started with trying to find out what they qualify for, would you recommend them to contact you both?
Yep, on our, I don't know that you can see our screen. Our contact information is out there and we can get shared. We can send out the PowerPoint to those that are interested afterwards, and it's got both mine and Ginger's contact information, but usually before you start house shopping, a realtor, for example, is gonna want you to be pre-approved to know what program and dollar amount and such to make sure that they're showing you houses that are in your price.
So they could connect with you via phone or email, set up an appointment, and just talk with you about, both of you, or either one of you, about the different programs available and what they would qualify for, so then they can kind of start the fun process of shopping, correct?
Yep,
Got it.
we do WebEx or Zoom meetings too.
Yep.
If someone's not able to come into the office.
Wonderful. Well,
Awesome.
I'm not seeing any other questions come through unless anybody in person has any other questions.
Nope.
Should we give them the rest of their evening back?
Yes, we certainly can.
Thank you.
Thank you.
Thank you, everybody, for joining this evening. We appreciate it and have a fantastic evening.